thing now.
Good morning, if you're in New York. This is the Fixed Income Investor Network Education Committee Spotlight Roundtable, Privates in the Market. I'm Ann Rutledge, the Education Director and founder of Credit Spectrum, a credit rating agency that I've been working on for 20 years. I have a distinguished group of panelists with me today. I'll let them introduce themselves. Maybe Manish, you'd like to start.
Great, thank you, Ann. My name's Manish Kapoor. I'm the managing partner at West Wheelock Capital and also the vice chairman of FIIN. My focus really has tended to be on looking at alternative credits and finding a pathway to securitization, and look forward to talking about that throughout this panel.
Great. Hello, everybody. I'm Mario Rivera. I'm a managing director at Fortress Credit. Fortress Credit, we run a value strategy. In particular, I run the asset finance business in the public markets typically, but we do have a considerable focus in the private markets as well, depending on the market environment we're in. We tend to be more thematic on our asset class selections, looking at the market stories that are out there when something's broken, or rather, better said, in transition. Think of the housing market in 2006 to 2008, how that just changed so frequently. We spend considerable resources and time trying to exploit that market opportunity. And it can be expressed in the public markets, i.e. CUSIPs, which tends to be a more broken plumbing trade, easier available, being sold because of liquidity reasons. And then eventually, once that corrects, we tend to pivot into the private markets, which is our bread and butter business. We spend a lot of time focusing on the gears of those transactions, the underlying collateral that supports a deal, the underlying or the servicing framework which manages that collateral, which can be challenging depending on the sector, and then of course deal structure, which is a lot of legal work that we tend to do with our resources, an army of legal folks that we now employ.
And I'm Joseph Lau. I'm the Chief Operating Officer of Lord Capital. We are an ESG-focused alternative asset manager that plays purely in the private capital markets. We were founded in 2003, really with the initial goal of putting equity and subordinated debt in structured vehicles such as asset-backed commercial paper conduits. And over the last 18 years, we've taken responsibility for more than $86 billion in assets. In the last 3 to 4 years, really our focus has shifted over to environmental-based lending, and have established an asset manager specifically intended to focus on that market. And today, our primary focus is on structuring our own transactions to lend directly to commercial property owners in order to facilitate them upgrading buildings, providing energy efficiency, and other forms of resilience measures.
Those are great introductions, and I'd like to just spend 1 minute to talk about why we're here. We are representing the Education Committee of FIIN, and the Education Committee of FIIN has as a goal the launch of an accreditation program. FIIN takes conversation and the improvement of the market through dialogue and exchange of information very seriously. So on the one hand, the accreditation program is an aspect of what we're doing. And on another hand, we will be starting a series of roundtable discussions that are focused on private ABS. And so we think this is a fantastic way to kickstart those roundtables and our initiatives. And we're grateful to IMN for letting us start the event today. So our focus may be on distress, but I think it's a little bit more on opportunity. So we've been talking about this panel. We've been talking as a panel offline for quite a while. And we really wanted to structure the conversation around what's happening now, how we got here, and where we're going. So in terms of where we are right now, there's an increasing focus on privates and whole assets as investors hunt for yield. Obviously, the three of you have sort of staked your professional orientation and your careers and your portfolios on this. Could you speak a little bit about what you're seeing and why you think it's happening now?
Sure, I'm happy to start that. And really the focus of this discussion is on privates. And I think there's, in many respects, none of us appreciate how big the private market really is, because there's such an opportunity and so many different opportunities when we think of what is the private capital markets as it relates to structured finance. We all have the ability very quickly to capture the total volume of the more public capital markets, fully registered and 144A transactions. We know how those are marketed. They're readily available to investors. So when we're talking about CUSIPs, when we're talking about registrations, those markets are easier to recognize. They're easier to participate in. But the private market really is everything else. So when we think of the size of this market, it's almost boundless. The opportunities really reach across different forms of execution. So in many respects, even in our own discussions, when we attempted to dimension what the opportunity set is, it's everything from purely bespoke transactions where an investor is working bilaterally with an issuer. It is co-purchase transactions where banks and investors are involved looking for different opportunities. It's whole loan financing that is either lightly or heavily structured. And even more recently, in the last few years, it's been an effort by especially the larger asset managers to really look to jump in line ahead of many of those participants that would otherwise be buying CUSIP deals to really capture supply before it ends up reaching the market. So when I think of the opportunity set, and it's really where we focus is working directly on a bilateral basis, but we see opportunities in so many other different submarkets. So they're just different ways that an investor can play based on their size, based on their asset interest, based on their capabilities, and based on their risk appetites.
I think that's a great way of looking at it. And I will add that it makes sense to just step away and think of some trends which have been in existence for almost a decade. So this is away from COVID. One, you have new silos of the economy, which didn't even exist earlier, and they're driving growth. Second, 0% interest rates have really upended the very basic pillars of finance. And at the same time, logically speaking, it's incentivized investors to engage in a lot of mental gymnastics in the hunt for yield. Lastly, and I think also most importantly, it's not about the cost of credit, but the availability of credit. You basically have a tale of two cities, whether you look at the US or across the pond, where largest companies have been able to access capital markets in record amounts at record low rates. However, smaller companies, SME, middle markets, and the like, are in trouble. And a good illustration of this is when the pandemic first started, the sector which was most directly hit was the travel sector. Yet we all saw multiple large travel companies where basically 100% of their business model was dependent on travel, were able to raise enough capital by May of 2020 to basically survive through the end of this year, 21, with zero revenues. And that certainly was not true of smaller companies, which were also not directly linked to travel and other sectors which were more or less 100% hit. So if you step back and you look at the ABS market now, it's roughly, depending on how you count it, 300 to 400, but 20% is alternatives. Pre-2008, there was 800 yards and counting, but 10% was alternatives. And my view is privates really have been the engine that is trying to slake the demand, which investors have for yield and the incentive for yield, but also the engine that effectively creates the pathway for assets to move into the alt CUSIP bucket, where people who start engaging in privates in a particular asset class really create the history, the process algorithm, the credit structure, and the legal framework whereby the asset class over time becomes a commodity. And it's not a coincidence that the fact that you have effectively negative real interest rates for a couple of years now after you take CPI into account has created so much interest in alternatives and privates.
Yeah, to leverage off of that last point that Manish said, this was a dialogue that was happening even before COVID. In January 2020, when you sat around the table and talked to your peers in the industry, everyone was saying, oh, we're no longer looking at CUSIPs, we're looking at private transactions. So I think, it's a mulligan 2020 sort of, and now everyone's back to the same narrative that we had prior to this COVID pandemic. On the point of the increased focus in privates, the way I think about it is investors can get yield from a whole different set of avenues, right? They can get yield from, I would say, 4 different categories. They can get it from changing liquidity, embracing complexity, credit risk, increased credit risk, and then duration. You can just buy a longer bond and get more return. When you go into the private markets, you're giving on those first 2. You're giving on liquidity and complexity. You're financing a transaction that isn't ready for the public market. So by definition, it has to be more complex. Maybe the data is not available or is readily established to understand that asset class. And of course, you're giving up liquidity. You can't go sell that loan or tranche that you've created as easily as you could a typical asset-backed security CUSIP. So when I think about the investors that are coming into these private markets, they're really pivoting some of their fixed income dollars that they're not as married to on liquidity into these private buckets to acquire more yield, because they're willing to give on some liquidity terms, embrace some complexity with the right managers, the right partners in the space.
Those are great contextual comments, but they raise a few questions. And the first question, well, Mario, you framed the search for yield as being answered or the demand being slaked by giving up liquidity, embracing complexity, accepting more credit risk, and accepting longer duration. But embracing complexity and credit risk can often be confused. Is this something does everybody who's coming to privates understand how to parse complexity and credit risk?
Well, they certainly should. Yeah, it's definitely a question I think you should have, and a dialogue you should have with any asset manager you're considering in the private space when they originate new collateral. How do they think about the company they're financing? How does their capital come in? How is it protected in downside cases? There's a lot of moving parts. I mean, the gears that I think about often, I said this in my opening comments, collateral. You get there through looking at tons and tons of data sets. And then, in the case of a new asset class, you look at data sets that could be comparable, right? You can only do that well just by having a huge history of lending already, right? Fortress has a big consumer lending platform that we leverage a lot when we look at new platforms. Servicing is another great dynamic. I mean, we've owned servicing for many, many years in many different asset classes, and servicing is often conflicted. Your manager who's originating those assets wants to do tons of volume, and you want to make sure it performs as advertised. That is a weird dynamic that you have to get right only by correct negotiation and making sure the incentive structure is correct. And then finally, the deal structure dynamics. I mean, there's a lot of legal that goes into these documents, making sure you sit with the counsel of whatever asset manager you're talking with, making sure they're commercial, right? Understanding business deals and really getting in depth and thinking about those, edge cases, those 5% or even lower scenarios when things don't go well. How does that loan that you originated actually work out? And I think you get comfortable by talking to guys like Joe or Manish or myself, where we just have teams that have done this a lot and actually understand the kind of ecosystem and relationship between public and private markets. Why you have to go first to private to ultimately get to the public space.
Sounds really
the one point I'll just make to Mario's is, I'm always interested by this dichotomy between optical and real risk, where the deltas can be negative or positive. And I always find that privates is not necessarily a great deal, but sometimes it's like the story of the $100 bill, where it's on the sidewalk because no one picks it up and everyone says, where the $100 bill? Ergo, it would not be on the sidewalk. So I highly recommend you try that with your own $100 bill in Midtown. You might be surprised. It might be 5 minutes before someone picks it up. But I do think a lot of it goes to us really questioning fundamental assumptions. So for example, Mario mentioned servicing, where pre-2008, servicing was looked upon as a back office function, a check the box. Whereas post-2008, there's real bandwidth being expended, not just by investors, but by rating agencies and regulators and so on, trying to understand servicing, trying to understand conflicts, if there's a real backup servicer, and so on. So I think you basically have to have this mindset where you look at everything in the food chain and you imagine that everything goes wrong, and then you try to mitigate it. Because my view is, it's not that you're trying to create a riskless investment. You're basically trying to make sure you're getting paid. Because at the end of the day, we're investors, and that means you are investing for risk commensurate with your risk. And what really gets people riled up is not necessarily when things go wrong, but things go wrong which they never expected to. Where in 2008, no one thought AAAs could lose more than a point. And they certainly lost more than a point, and people got riled up. And my analogy is that happens in equities all the time, but people don't get riled up because that's expected. Equities are expected to be volatile. So my basic thesis is, a good private investor really has to understand everything that can go wrong in the food chain, both quantitative and qualitative, and either mitigate it or be comfortable that they're getting paid to assume that risk. And then you try to sleep at night.
No, and that's a really important point. It always gets back to structure. I mean, we've all three of us are big on data and analytics, but your structure has to hold. And anytime we're analyzing something, it's how can we ensure that we have the flexibility in our structure, because we know we're the ones that have to protect ourselves if there's an issue. And I think the more time you spend on CUSIPs, the expectation is that there are other parties that are going to be looking out for your interests. And unfortunately, the past has shown us that there have been many instances in many markets where that has not been the case, but it's absolutely highlighted in the private market that you're your own best advisor and supporter. And you have to make sure that you're looking out for your interests. And that's where we find, and it gets to Mario's point about having the appropriate resources. You need relationships, and you need great legal relationships, servicing relationships. It's partners. So we don't have to have a team of 50 people within our organization, but we certainly need to have the right groups that we're working with that can give us appropriate support, whether it's directly when we're working on a deal or knowing that there's someone we can call when there's a problem, because there's no way we can leverage the internal resources, or develop them for that matter, to adequately address all of the risks that we might face.
And I think that's a really good point, that, going sort of closing the loop on, you need good advisors, you need good, a good attention to detail. You need to be able to leverage what you know from the past. You can't really count too much on anybody, and yet you just need to surround yourself with smart people, which I guess is why we all belong to FIIN as well, right? Because you'd never know where it's going to come from. When I think about where things can go wrong, this is nothing really new. This is a challenge. Anytime you're looking at a new sort of horizon of dealing opportunity. When I was working for Moody's, I was the analyst on the first Thai car deal and the second Thai car deal. The second Thai car deal didn't go the way the first one went because the government cracked down and froze the bank accounts. And it was a monoline wrap deal. But in the end, the monoline and the investors got repaid, because what happened is that the cars got sold to Hong Kong and for on sale into China, where the price points were, grossly inflated. And the sale of the cars was enough money to pay everybody off. Now, nobody anticipated that the deal would work out that way. And it was serendipitous. But so all the minds in the world, probably wouldn't have foreseen that scenario. Which leads me to a question. We sort of take the past for granted, and I want to come back to that point. But can the three of you give us some color on what kinds of deals are getting done right now? I mean, we're talking in the abstract, but what are we looking at here?
Yeah, I mean, I would say platforms that are in their nascent stages of development, right? It's a new spin on consumer credit. It's a new type of auto loan that is, leased to a special credit borrower, where maybe it's a 1-year lease. Those types of things are what's getting done in the private market, traditionally in the asset finance. I'm just talking broad terms. Like residential is another great example, right? Fix and flip loans, which are now solely in the securitization market. Just about 2 years ago, they were only financed in the private placement market. So when you think of what's getting done in the private market, just ask yourself what's not getting done in the asset-backed security market, and that will lead you to the answers. You guys, before this call happened, there was a bunch of emails trading around sports finance. Those transactions are getting done in the private markets. I would say they're not terribly scalable, but the idea of financing a professional sports team, their broadcast revenues, that athletes' professional salary, those are all being talked about right now in the market today, but can only be really in the private market simply because there's just not enough data for traditional banks to finance them, right? If you ask yourself the question, would Goldman Sachs, would Credit Suisse, would Citigroup, no, sorry, I missed everyone else's name, would they finance these companies? And the answer is no, then you're definitely going to be in the private markets for that. You'll find some alternative source.
The one thing I'll add to what Mario said is it's also good to see how finance is being delivered, where if as an average retail consumer, you looked at how you access finance roughly 10, 15 years ago, there were certain large vertical platforms, Citibank, et cetera, Bank of America, who you went to, whereas that distribution has become so very decentralized. We have ourselves seen a number of new names which have become regular way issuers, and marketplace lending obviously has become a new asset class. But when it comes to privates, the other thing which I think is also interesting to keep in mind is you really have this blurring of line between who's an investor, issuer, and a bank. So to Mario's point, for example, some of the sports financing coming out is very similar to a credit line or a bank loan you would get, but it's coming out of a large insurance company. And similarly, you see large asset managers providing warehouse lines where if I took their name off the letterhead and just showed you their activities, they're behaving very much like a sharp, aggressive commercial bank. So the blurring of the lines leads to more effective powder being expended. But I also think in terms of the entities which are providing financing at the small business level, and especially at the individual level, that is becoming very fragmented. And all those entities effectively have realized that their basic competitive advantage is cost of funding. 6 years ago, it really was how big is my balance sheet and how quickly can I IPO at $1 trillion. That trade has gone away. Now it's really become a trade of how can I try to have some real revenues. And if you think about it, if you're in the business of finance, logically speaking, your biggest raw cost, so to speak, is the cost of the capital you're lending out. And that's where privates and ABS down the road can be very useful. And you see that trend all day long.
Yeah, and then one thing I would add is it's bespoke transaction. So where it's very complex structuring, the capital markets don't want that. They want straightforward transactions with clean structures that they already know. So if the asset has a lot to it that the market is not readily able to digest, then the private market makes sense for that. So if we're talking about an edgy or a newer asset with data issues, that's one execution. But then if you're going to overlay something where there obviously are pre-funded deals done all the time, but it's a complex pre-funding. If there's a difficult ramp up, if there's a lot of construction or execution related risk in it, then you're better suited to work with one or a few private partners that are going to help be able to understand those types of risks. better. And even if they're pricing for them, then they're able to work directly with an issuer, where you're not going to be able to do that in a right way capital markets execution.
I just saw this great question pop up about tail risk, how we price for tail risk, private transactions. I think that's a really, really important topic. I think you're on mute, but the way Fortress would think about tail risk, you can't price for it. I mean, COVID was very unexpected to everybody, and it affected every single asset class. But the way we think about protecting against those scenarios is creating a framework, a structure where we're still on the right side of the 50-yard line. We have better field position than the person we're financing. We have collateral that we can use to get back to have a recourse guarantee from the counterparty. We hold the wheel as far as we want to steer this ship, right? Those are things that I think you can do to protect yourself from tail risk. Securitization absolutely does that too. If you think about CLOs and people were concerned that losses were going to be 50% of the entire collateral pool, those things are structured to benefit the senior parts of the capital structure, to amortize down the AAA bonds if losses increase enough, to shut off access to the equity holders. So, structuring things where you just know you have a better probability of outcome than everyone else, or your counterparty, you kind of hold the cards, I think is the best way to approach this stuff. And then you just simply get into your experience about how many times you've had these workout situations go, and how you've been able to enforce that personal guarantee that you didn't think was a big deal, but you asked for it anyways because you knew that borrower was a little difficult to deal with. It kept their alignment right. And I think that's a really good point. It goes back to my public-private pivot. Private investing is not for the casual investor, right? We think of public markets as we're private operational people first. We understand the gears, and then we go and invest well into the public markets. Be very cautious on someone who is traditionally a CUSIP investor only, and then want to pivot into the private markets because they think they can. It's a lot of work, right? We've seen it happen. There's huge, large institutional money managers who are now coming into our territory, and it's aggressive. It's aggressive, frankly, because they just don't have the experience in these workout situations. And this tail risk question really underscores that.
Exactly. It always comes down to structure. You can try to figure out how to price everything, but as Mario said, COVID was the ultimate situation where you could never have foreseen that. I mean, we look at our own experience. We were equity in asset-backed commercial paper conduits in 2008. And I always have to knock on wood. We never took a dollar loss. And that was because of the structuring in deals and going through workout. And you can't replicate that type of experience and the amount of time and energy that goes into it. So hopefully a very low probability that you're going to have those events as an investor, but your organization needs to be prepared and then aligned in a way that you're able to actually work through them. And it's why I talk about having partnerships, because you have to have the ability to flex to address these, and you have to have the appetite and be prepared that addressing issues is something that is just going to happen at some point in time. And you're not going to get paid for them because you naturally never get paid for the workout that you have to invest.
And the way I think about tail risk, because not to sound like Donald Rumsfeld, but you have known unknowns and unknown unknowns, what you don't even know that you don't know. So for example, in terms of known unknowns, my view is the road to bankruptcy is paved with people who think they can predict the macro future, and no one can really do that consistently well. So we don't really know what GDP growth will look like next year. We have some pathway out of COVID, but we don't know if that's too optimistic or too pessimistic. And then there are certain events which happen without any warning or any way to predict them, including COVID or other events. We don't have to think about something which is so very significant, the time when oil prices went negative. No one foresaw that. That was for a couple of days, or more recently in Texas, when energy costs multiplied by 10,000%. No one saw that coming. Certain people profited from it. Other people lost a lot of money. But my view is the one thing which is useful in privates is you have a little bit more control of your destiny. You have assets which are more specifically engineered in terms of your preferences. You have more direct lines of communications. Whereas in CUSIPs, your point of intersection with the issuer, where you have a seat at the table, really is much further down the road. Your point of intersection is not the first servicing report when you see a degradation. You really need to hit a trigger for you to be able to do something. And furthermore, this is one of my sticking points in fixed income, even when you have a credit event, in terms of being able to figure out who the investors, et cetera, are, it takes some time until you get to, you don't have sort of the UCC as you do in unsecured lands. So I feel privates is not for everyone. There is a lot of work. You are not getting paid free money. There is complexity. There is additional mental overhead you have to engage in. But as long as you understand those few points, there are certain benefits as well, which you don't have in CUSIP. So I always think it's a balancing act. And tail risk can be mitigated by structure. And it can also be mitigated by, in general, trying to think of everything which can go wrong. And you never know when some structural enhancement might help you in a way which you never intended it would.
Yeah, and that benefit I think is important. I'm sorry, Anne.
Please.
We don't want to sound negative, and as this conversation is going on and we're highlighting the complexities, we certainly don't want to give the people the impression, if they don't invest in privates, that this is a dangerous market and you wouldn't even want to consider it. It's just it is a complex one. You know, we work with investors quite frequently that are newer to the sector or like certain types of risk that we structure, and I can certainly say the same thing for many other asset managers. So it's really just a matter of how you want to approach the market. Is it something you want to dive into and invest resources because you see enormous opportunities, because there are, or is it working with someone that has the experience because they're able to help leverage many of the tools that they have to assist investors that are seeking outsized risk-adjusted returns for certain types of investments?
I would agree with all that, and just add to it that the word, I think from our standpoint, the word tool is very important. You know, I came to structured finance with a background in exchange traded risk, where tail risk meant something rather different than it does in fixed income. And coming up through a rating agency background, which is primarily a public background, the idea, you know, I'll agree with my partner Donald over here that the capital structure is there to reflect the volatility or the uncertainty of outcomes. Certainly in the public sector, that's an ideal. In the private space, it's not possible because, I think as we're all saying, the historical experience simply isn't there for you to make a very meaningful assessment of the potential volatility. But at the end of the day, tail risk is volatility, and that's what you're getting paid for. So the tools that you're using, I think, to make that assessment also matter. The first tool is your brain, but then beyond that, you know, the quality of the modeling and your ability to go back and forth between probability and dollar value. So
It's data, it's data as well. I'd add, you know, data and people, right? People and experience, right? I mean, when we structure deals, we talk to our counsel pretty frequently, like, when have you seen this type of situation before? And right, and just something always looks like something else, right? And so having that chest of just resources available, I think, is really important. And then data to figure out how you size your debt, right? If you're financing a pool of consumer receivables, what's the right advance rate, right? And data can really help you there. So,
you know, I do think one of the oh, go ahead, please. Sorry.
No, I was just gonna say, you know, to Joe's point, like, we're not negative on privates by any means. This is a great space. It's just, you know, I think one of the real points of this dialogue is to make sure the people listening on this call, when they think about privates, that they're asking the right questions to their managers. You know, they're focusing on the right topics and asking what could go wrong. What are the unknowns, you know, that or flags that those exist? Should I avoid that topic? So, and then, you know, to the managers on this phone, it's more of, you know, giving them the resources to be able to answer those questions.
And I think
I do
that
also think that it's helpful if you go through a few credit crises, you have those under your belt, like 2008, etc., because it helps you to understand that it is so very important to question fundamental assumptions. Where if you think about ABS, it sounds very complicated, but at the end of the day, it's fairly simple. You have a asset, you ring fence it, you get access to the cash flows, and hopefully everyone goes home happy. Now, there are a lot of things which can go wrong there, including things like ring fencing the assets, et cetera, where, we saw that in 2008, where you had a very vanilla asset called the resi mortgage, which has been around for decades and decades. And when people went to actually take possession of mortgages, they found that it was not as easy as it was supposed. So my point is, I think privates make a lot of sense. You just need to work with the right people who have the right mental model. And I would say even in the CUSIP space, there have been instances where certain fundamental assumptions need to be questioned more. But as long as you think about it through the eyes of experience, it's nothing which you cannot navigate if you spend enough time just working through the food chain in terms of where the weak points are.
So we have 3 minutes left, and I'd like to get a little insight from all of you as to where you think we're going, because our basic premise was privates make sense because they satisfy our need for yield. Privates are not scalable, but there may be opportunities to scale because the past, as the best guide to the future, shows us that new markets become mature markets with scale. But how scenario dependent is this view? Will this market be marginalized by government projects? Will it bump up against or spill over into the cryptocurrency space? Will it just stay small and private? What do you see?
One thing I will say is I definitely don't think the market is small. The optical markets, the optical markers of the market may be small just because you don't have league tables for privates. You don't see the CUSIP sizes as you do at the end of the year in ABA. But I think the private market has been large and is even larger now. And my view is very simple. You look at the largest organic investors, which tend to be the pension funds. And if you're a pension fund, what's your number one worry? It's basically there's a certain amount you have to pay your retirees. And right now, absolute and relative rates are low. We have central bankers very publicly announcing that they expect rates to stay zero for not the next couple of months, but the next couple of years. So I think that simple dynamic itself is going to drive more and more people into privates, and that trend will continue. So I'm actually very optimistic on privates, and I think the market will keep getting larger.
It's a good question, Ann. I mean, it's kind of, I view it as a little bit of an accordion. If we had a round 2 of COVID and everything was shut down and REITs were liquidating their positions overnight and on weekends, we wouldn't be having this private conversation. We'd be talking about, how much impairment are going to be in a typical RMBS security. So it's a function of what is the opportunity set out there at the time. If all else being equal, the market holds, and interest rates are low, Manish's thesis is right. But it does change, and the right platform to pivot correctly in different ecosystems.
Yeah, I think all of that's important. And 5 or 7 years ago, a lot of the assets that we've seen were more readily financed in leveraged finance markets, private bank markets. So we just weren't seeing them in any form of structured credit. Now there is a benefit to being able to access those in our market. And we anticipate that for all intents and purposes, this is going to continue as the dynamics remain as they are. There are things that can change that, but I think one emerging theme, if you think of it from the structuring standpoint, was that people saw it was very, very hard and there wasn't an option to be able to structure them because they were all brand new. And the technology and the around structuring has gotten better in recent years. So they are a better alternative than they had been 5, 7, 8 years ago. So some of the momentum is also just driven by there are more analogs for people to be able to choose if you're an issuer and seeking ways to access this form of capital. So that's going to continue to help support using this as an issuance tool.
Well, it's time. This has been a great conversation. I want to thank my panelists and see you around at the next roundtable.
Thank you, Anne.
Absolutely.
ya.
Thanks, Dan. Take
Thank
care,
you,
everyone.
everybody.